Welcome to the Deep Dive. Today we're asking something kind of interesting. Can a company's financial report, one from over a decade ago, actually hold relevant lessons for today?
It seems unlikely on the surface, doesn't it? Like 2010, ancient history in business terms.
Exactly. You might think, okay, stale numbers, dusty shelf. But Markel Corporation's shareholder letter from that year, well, it's different.
It really is. It feels more like a masterclass in thinking long-term, being adaptable, and maybe surprisingly, being really transparent.
So today we're taking that deep dive into Markel's 2010 shareholder letter. And this isn't, just some dry financial document.
Not at all. It's really more like a window into how they built this unique identity, how they faced what they called unusual uncertainty head-on.
Right, that post-2008 feeling, and how they laid out a vision for durable growth. We're pulling insights straight from the letter itself.
Yeah, getting it from the source.
Our mission for you today. Let's try and extract that core wisdom from Markel's 2010 perspective. We'll look at how they measured success, how they adapted their business, fundamentally adapted it, and how they made these crucial investment and acquisition choices in what was, let's face it, a really tough economic climate.
The idea is you'll walk away with a clearer picture of what it takes to build a company with integrity with that long-term view.
And hopefully some valuable frameworks for your own thinking, whether that's business, investing, whatever. So let's get into it.
Okay, so first off, what really jumps out is this idea of an uncommon relationship they wanted with shareholders.
Uncommon. How so?
Well, they weren't just focused on the next quarter. They explicitly talked about building long-term value with capital and patience. It's just a different rhythm.
Patience isn't always common in markets.
Exactly. And this ties into what they called the Markel style, integrity, valuing people, associates, customers, and just sticking to that long-term path, avoiding shortcuts. That's the foundation.
Okay, so that's the philosophy. But you mentioned long-term value. How did they actually, measure that? Especially in a messy year like 2010, what was the number they watched?
They were super clear about it. Their main metric, book value per share.
Book value per share, right?
Yeah. Basically, the company's net asset value, what shareholders might get if everything was sold off and debts paid. They saw it as the best proxy for the real intrinsic value they were building.
And how did that look in 2010?
It hit a new record high then, $326.36. That was a 16% increase just from 2009.
Wow, 16% in that environment is pretty strong. But you said long-term. How did it stack up over, say, 5 or 10 years?
That's where it gets really telling. That $326 figure, it represented a 13% compound annual growth rate, the CAGR, over the previous 5 years.
Okay.
So growing steadily from about $174 back in 2005, and even better looking back 10 years from 2000. It was a 12% CAGR, starting from roughly $102.
So consistent compounding even through the dot-com bust and the financial crisis.
Exactly. Even through, as they put it, challenging financial environments and treacherous markets. For them, book value per share was their North Star, their reasonable proxy for performance.
So Markel acknowledged the times. They talked about unusual uncertainty, the new normal in 2010. They knew things felt different.
Right. But they didn't just, state the obvious. They saw it as a trigger for change.
A catalyst, yeah.
Yeah.
So what did that uncertainty make them do? What shifted?
Well, it pushed them to ask, how do we adapt? And the answer involved making some pretty dramatic changes, as they called it.
Not just tinkering around the edges then.
No. This was fundamental stuff. They changed their business model for how they marketed and distributed insurance. Big leadership changes, overhauled IT systems, expanded globally.
And they added Markel Ventures, right? That whole new arm.
Exactly. It was a really comprehensive strategic shift, driven by this sense that the old ways might not be enough.
And guiding this were, what, 2 core realities they focused on?
Yeah, 2 things they saw as fundamental. First, technology changing fast, really fast. They knew they needed to be fast, flexible, and cost-effective there.
Makes sense. And the second?
The second was timeless, the crucial importance of talented and honest people. They believed that surviving and thriving through any challenge, economic, regulatory, tech, ultimately came down to having the right people.
So tech changes, but people remain the bedrock.
Pretty much. And you see this reflected in their actual decisions. It wasn't just talk. It was baked into how they operated. They understood where the real enduring value comes from.
Okay, so we've got the philosophy, the core beliefs. How did that translate into, the numbers and the big moves in 2010? Let's look at the financials. Total operating revenues were up 8%.
Yeah, hit a $2.2 billion, up from $2.1 billion the year before. Earned premiums were about $1.7 billion. So definite top-line growth despite everything.
And for an insurer, that combined ratio is key, right?
Yeah.
How did that look?
Right. The combined ratio tells you if they're making money on the actual insurance underwriting before investments. A number under 100% is profitable. Theirs was 97% in 2010.
Still profitable then.
Still profitable, yes, but it was up slightly from 95% in 2009, so costs relative to premiums ticked up a bit.
Any particular reason for that increase?
The letter points to a few things. Big ones were the Deepwater Horizon disaster and the Chilean earthquakes, major loss events.
Ah, okay. Catastrophes.
Yeah. Those, plus some expenses from their big IT projects, added about 2 points to the loss ratio and 3 points to the expense ratio, collectively. So, still made an underwriting profit, but those events definitely hurt.
But despite those hits, their balance sheet looked solid.
Very solid. Total shareholders' equity grew nicely to $3.2 billion from $2.8 billion. And interestingly, their debt-to-total capital ratio actually declined a bit to 24% from 26%.
So growing equity and reducing leverage, that speaks to that conservatism you mentioned.
It does, especially their discipline around loss reserves. And then there's the investment side. They called it a fabulous year for investments.
Fabulous. What were the returns?
7.9% total return overall. Equities did great, up nearly 21%, 20.8% to be precise. Fixed income, bonds, up 5.4%.
Nice returns.
Mm-hmm.
But you said they were worried about something.
Yeah, the letter is pretty explicit, optimistic about stocks, but definitely concerned about interest rates going up.
Okay, so rising rate risk. What do they do about it? How do they manage that risk?
This is a great example of that long-term view in action. Over the prior 2 years, they had been actively shortening the maturity of their bond portfolio.
Meaning they were buying bonds that would pay back sooner.
Exactly. They knew and stated this would probably hurt their current investment income a little. Shorter bonds usually yield less.
Right.
But they felt it was the right decision to protect the balance sheet from potential big price drops in bonds if rates did rise significantly. Protecting the principal was more important than maximizing current yield.
That's a really clear trade-off. Sacrificing some income now to avoid a potentially bigger loss later. That definitely tells you something about their priorities.
It really does. It's about durability, not just squeezing out every last penny in the short term.
Okay, let's shift focus to the wider insurance market back in 2010. Markel had some pretty blunt things to say about it.
They did. They saw a fundamental problem. Way too much capital chasing too few attractive risks. Supply massively outweighed demand, basically.
They put numbers on that, didn't they?
Yeah, citing AM Best, they noted about $550 billion in capital sloshing around the U.S. insurance industry against maybe $400 billion in total premiums written that year. That's a huge gap.
So tons of money looking for insurance risks to cover.
Exactly. And part of the issue was also not enough risk being generated. The economy was still reeling from the financial crisis. Activity was suppressed. Risk was kind of a bad word.
But they expected that to change.
They did. They figured as the global economy recovered, as living standards rose, demand for insurance would naturally pick up and help rebalance things over time.
Now, here's where they got really candid. They called the industry's way of labeling risk idiotic. That's a strong word.
It is. Their point was fascinating. In soft markets like 2010, when prices are low, the industry looks flush with capital, maybe even overcapitalized, and therefore less risky on paper.
Okay.
But then, when the market hardens and prices go up, suddenly the industry looks riskier, maybe even undercapitalized, because premiums are rising relative to surplus.
Even if the actual underlying risks haven't changed that much.
Precisely. They argued this perception cycle actually magnifies the price swings and creates unnecessary volatility. It's a really sharp critique of how surface-level metrics can mislead.
It's a good reminder for anyone looking at industry data, you need to look deeper. So faced with this idiotic cycle and soft market, what was Markel's plan? How did they aim to grow?
They laid out 5 clear strategies. They weren't just going to sit back and wait for the market to turn.
Okay, what were they?
First, double down on specialty insurance. Focus on niches, new markets, complex risks where deep expertise matters more than just price, especially where there isn't tons of historical data.
Play to their strengths.
Yeah.
Makes sense.
Yeah.
What was number 2?
Second, maintain flexible underwriting. Be willing to shrink writings in a specific line if the pricing just isn't adequate.
So discipline. Don't chase bad business.
Exactly. And then be ready to re-enter when things make sense. They mentioned getting back into directors and officers liability in 2010 after pulling out entirely back in the 90s. That takes patience.
Okay. Third strategy.
Third was growing their capital base and geographic reach. Having more capital allows you to take on larger risks, and spreading out globally diversifies things. That's why they were opening offices in places like Hong Kong, New York, Barcelona in 2010.
Expanding their footprint. Got it. Fourth.
Fourth, recognize that even with their growth, they were still a relatively small player in the massive global insurance market. So plenty of runway to increase market share, especially using technology to reach more customers efficiently.
Room to grow within the existing pond. And the fifth strategy.
Number 5, tied it all together. Thoughtful capital management, always judged on a per-share basis. Meaning constantly asking, where's the best use of our next dollar of capital? Should it go into organic growth, an acquisition insurance, or maybe something else? Or should we buy back our own stock? Whichever option promises the best return per share for the long run.
That's a very disciplined framework. Taken together, those 5 strategies paint a picture of a company determined to control its own destiny, regardless of the market weather.
Absolutely. It's proactive, not reactive.
Okay, let's pivot to Markel Ventures. You mentioned they added that arm.
Yeah.
How was that performing by 2010?
Performing very well and growing fast. They highlighted going from just one business back in 2005, doing maybe $50 million in revenue, to having 6 businesses expected to generate over $250 million in revenue for 2011.
That's quite a ramp up in just 6 years.
It really is. And with that growth, they introduced a new metric specifically for ventures, EBITDA, earnings before interest, taxes, depreciation, and amortization.
Right, EBITDA. How did that look?
For 2010, Ventures EBITDA was $20.4 million. That was a huge jump from only $4.6 million in 2009.
Wow. Now, didn't they include a whole section explaining why they were using EBITDA for ventures? I remember you saying they were usually cautious about that metric.
They did. They called it a digression on accounting. It's incredibly insightful because it shows their commitment to transparency. They basically walk through why they added back each component for these specific businesses.
Okay, break that down. Why add back interest, taxes, depreciation, and amortization for the ventures companies?
Sure. Interest was easy. Most ventures companies had very little debt, so interest expense was tiny anyway. Taxes were added back mainly for comparability, to look at the underlying business performance on an apples-to-apples basis across companies that might have different tax situations due to debt levels.
Right. And depreciation.
Depreciation was also minor because, and this is key, one of Markel's main criteria for buying these ventures companies was that they are not capital intensive. They look for businesses that don't require constant, huge investments in machinery or facilities just to stay competitive.
So depreciation just isn't a big economic factor for them. What about amortization? They called that the most interesting part.
Yeah, amortization was the big one. They argued that for their ventures businesses, amortization, which often relates to intangible assets recognized during an acquisition, like brand names or customer relationships, is really just an accounting convention.
An artifact of the purchase price.
Exactly. They believed it doesn't reflect the operating cash flow realities, it doesn't drive management decisions, and crucially, it doesn't capture the true economic value of a well-run business with strong brands, which they argued should actually be increasing in value over time, not decreasing as amortization implies.
So the accounting number might go down, but the real value is going up.
That was their argument. They wanted shareholders to understand that distinction when looking at the venture's performance. It's a sophisticated point about the difference between accounting rules and economic reality.
Very interesting. Okay, acquisitions were clearly part of the strategy. What were some key ones in 2010?
A big one on the insurance side was First Comp. They specialized in workers' compensation, serving thousands of retail agents, and Markel liked their marketing and technology focus.
And they were upfront about the near-term outlook for First Comp, weren't they?
Incredibly upfront. They stated right in the letter that they expected First Comp to post a $30 million underwriting loss in 2011.
Wow. Why acquire it then, and why be so public about the expected loss?
It goes back to that long-term view and conservatism. They saw long-term value in First Comp's platform and market access, but they knew the workers' comp market was tough right then, and they applied their own conservative reserving standards immediately. Being transparent about the expected loss set realistic expectations.
Sets the stage properly. What about on the ventures side?
They added 3 more operating companies: Solburn, which makes food processing equipment; Retail Data Systems, providing retail intelligence, and Diamond Healthcare, focused on behavioral health services. Plus, some non-controlling stakes in real estate and asset management. A diverse bunch.
Definitely diverse. What makes Markel an attractive buyer for these kinds of companies? What's their pitch to sellers?
It's pretty unique. They offer a long-term home and permanent capital. Unlike many private equity buyers who might use lots of debt and plan to sell the company again in 5, 7 years, Markel comes in saying, we want to own this business forever, support your management, and let you keep doing what you do best.
That must be appealing to founders or family owners.
Hugely appealing. They estimated maybe 90% of other buyers have a different model. Markel's approach aligns with their acquisition checklist, too. Find profitable businesses with good returns, honest and talented managers, chances to reinvest capital wisely, and buy them at fair prices. It's consistent and owner-focused.
Okay, let's touch on operations quickly. Technology, they had that big Atlas initiative underway. How was that progressing in 2010?
They reported that new systems were actually starting to be delivered, but interestingly, they also said the Atlas name itself would likely fade away
Why is that?
because they shifted their thinking. IT wasn't a one-off project anymore. It was now seen as a continuous, ongoing effort. Capital would be allocated regularly to adapt, maybe build a new data warehouse, improve online tools for agents, prune old systems.
So IT becomes just part of the normal evolving business process.
Exactly. The goalposts remain the same, though. Fast, flexible, and cost-effective. Continuous improvement rather than big bang projects.
And finally, leadership. They formalized a succession plan in 2010.
They did. They set up an office of the chairman, Alan Kirshner, as chairman CEO, with Steve and Tony Markel as vice chairman focusing on strategy, and then an office of the president, Mike Crowley, Tom Gaynor, Richie Witt handling day-to-day operations.
That sounds complex, an office of the chairman and an office of the president.
They acknowledged it was an unusual structure, but they felt their long history, decades of success, with clear roles, mutual respect, and shared goals, made it workable. It was designed to blend teamwork with individual autonomy and ensure that Markel's style continued.
Culture makes structure work, maybe.
Seems to be the case there. It was about ensuring continuity and long-term stewardship.
So wrapping this up, looking back at Markel's 2010 letter, it really does offer more than just old numbers, doesn't it?
Absolutely. You see a company deeply committed to its core values, but also incredibly adaptable strategically and remarkably open in its communication.
Yeah, navigating a tough time with a really distinct playbook for insurance, for investing, for growing through acquisition. We saw how they use metrics like book value, how they manage capital with an eye on risk, even how they critique their own industry.
That idiotic cycle critique was memorable.
It really was, all while keeping that steady long-term focus.
Okay, so here's a final thought for you to chew on, building on all this.
Lay it on us.
The specific market conditions of 2010 are history now. But think about Markel's core principles. Those durable values, the constant technological adaptation, betting on talented people, providing that permanent capital for acquisitions. Does that framework still offer a powerful way to navigate the uncertainties we face today?
How might you apply those lessons? Focusing on long-term value, critically assessing the conventional wisdom around you, whether it's in your job, your investments, or just building something you care about. How do you build something to truly last in any environment?
Something to think about.